Welcome back. This is Hugh Johnson, chairman of Hugh Johnson Advisors, and I thought it might, given the kind of volatility that we've seen in the stock market the last couple of days, particularly an 800-point plus decline in the Dow Jones Industrial Average that we saw yesterday, it might be a good time to get back on the line with you to give you a little bit of an idea of how I see things, how we see things, and what we might be doing about it with regard to the kind of the portfolios that we manage. This obviously, when you see an 800-point decline, it tends to jar you. It tends to get all of us. We don't like seeing it, and it's a very emotional kind of a moment. So it's really important to talk about it, to explain it. The first thing is, and the most important question, as I'm sure is on your mind and is certainly on just about everybody's mind, is that does the 800-point plus decline in the stock market mean that we've reached the end of the current stock market economic interest rate cycle, or can we treat this simply as a decline, a correction in an ongoing bull market, that we have further to go in the current cycle? And that question becomes very pertinent when you're at the 115-month mark of the bull market, because after all, this is the longest bull market in history. It's not going to go forever. There will be an end to this bull market, and there will be a bear market accompanied by a recession. As some of you have read my last market letter will know, the good news is that we're going to have that sooner or later, but that my guess is that the bear market and the recession that follow this very long bull market are going to be very close to what we call historic averages. And fortunately, happily, bear markets are not as long. They're only about, on average, say something in the order of 14, 15 months, nor are they as severe as you might worry about, certainly not as severe as the financial crisis of 2007, 8, and 9, something in the order of, say, 20 to 25%. And of course, what we're going to try to do is manage portfolios in a way that we reduce equity exposure during the bear market and the recession. In other words, to preserve capital during that period of time. There are no guarantees. We were able to do that fairly successfully in 2008 and 2009. We're hopeful that some of the work that we've done on asset allocation will enable us to do that as well this time out. But obviously, there's no guarantees. It's a very difficult thing to try to figure out when you're indeed in a bear market that's going to be accompanied by a recession, and you need to take those steps. But we're working really hard to make sure we can try to make that decision the right decision. So back to the real question, which is this a bear market accompanied by the start of a bear market accompanied by a recession, or just simply a correction in an ongoing bull market? And I can give you three reasons why where I come down is that this is simply a correction in an ongoing bull market. The first and foremost is, of course, taking a very hard look at something very technical, the yield curve. The work done by the Federal Reserve Bank of New York tells me it quantifies the probability of a recession starting in 12 months. And that probability is getting higher, but it's only up to 14, 15%. And until that probability gets up to 30%, I'm not going to be overly concerned. I'm going to be concerned all along, but not overly concerned. So we have to see a higher probability of a recession starting in 12 months. The second thing, which is important, is the index of leading economic indicators. Those of you that have followed my broadcasts as well as some of my writing will know that I pay a lot of attention to the index of leading economic indicators, and it's by its very name. It's the leading economic indicators, or these are indicators that tend to lead turns in the economy. And that index has been rising for 27 consecutive months. 2 months the number was unchanged, but basically 27 consecutive months of rising and sending a message that indeed we've got further to go in the current stock market economic interest rate cycle, that there's no signs from the index of leading economic indicators that the current expansion in the economy is about to end. And the third thing that I would point to is that the performance of the markets prior to this 800-point decline, performance of not only the stock market overall since March, but also the performance of different sectors, the performance of stocks with different capitalization, the performance of spreads in the technical things like the yield curve, technical things like spreads in the credit markets. They seem to be saying that although it's not unambiguously true, there is some ambiguity, have been saying or sending the message that things are going to be just fine, that investors collectively are saying we have further to go in the current cycle. There's certainly some problems out there, worries about the tariffs, trade wars, legitimate worries. But nevertheless, the message of the markets prior to this 800-point decline was quite clear, and that was that we'll manage our way through this. Both the global economy will continue to expand, as well as the U.S. economy will continue to expand. So right now, we have not made any change. Currently have not made any change in our asset allocation or the percentage of assets that are invested in the equity markets. I said one time ago that it's important to understand that, look, it's important to sleep at night. And if for some reason or other you can't sleep at night, if you say to yourself, for example, that, look, Hugh, this has been a very long bull market. We've made a lot of money in this bull market. We've done well. We've prospered. I think it's time to reduce my equity exposure. If you were to call me and say we should do that, even though I would say we have further to go in the current bull market economic cycle, that's certainly not irrational to say that. If it makes you feel better, it makes you feel more comfortable. When you're at the 115-month mark and the longest bull market in our history, statements of that sort, decisions of that sort, are certainly not irrational and well understood, and some might even go so far as to say, and I think I would say, somewhat sensible. So certainly give us a call if you feel uncomfortable with your current exposure to equities, or you feel uncomfortable about the current economic, political, and financial market environment. That's almost all I have to say, just to bring you up to date. I know these things are very tough emotionally when you see declines of the magnitude that we've seen. They are tough for you, they're tough for us, but you should rest assured that I believe, have really good working disciplines in order to try to manage our way through these difficult periods, or at least to try to evaluate these periods for what they are, whether they're corrections or whether they're the start of bear markets. In a week, we may change our mind. I doubt it, but we may change our mind. And if we do change our minds, our collective minds here at Hugh Johnson Advisors, then we'll, of course, be back on talking to you about the reason that we're changing our minds. These are very, very volatile times where we have to be sticking with our disciplines. You can count on it that we'll stick with our disciplines, and I cross my fingers that they'll work just as well in this current cycle as they did in the cycle that ended in 2007, 2008. Once again, thank you very much for your confidence in myself, confidence in all the professionals here at Hugh Johnson Advisors, working hard every day to get better and better at managing portfolios in a way that's important to me, that's a way that's sensible. We might not knock the cover off the ball, but we can certainly manage portfolios in a way that is sensible if we stick to our disciplines, which we plan to do. So thanks again. Call me, call anybody in the group whenever you get a question or concern. And of course, if you wanted to change your asset allocation, or you just simply want to chat about the current economic and financial market environment, just give us a call. Pick up the phone calls. I look forward to talking to each and every one of you. So thanks again, and have a great day, and talk to you soon.